Well, good afternoon then, folks, as we are at the end of another week of trading on Friday the 15th of September. We'll have a look across the calendar, we'll have a flick across the charts, and a pretty busy week in terms of the calendar, and also a bit of movement across the charts this week, as the US dollar is set to notch its ninth straight week of gains in a row. Obviously the longest stretching back since 2014. Bull run on the US dollar. Certainly, I say US dollar, but certainly euro dollar downside, but a cable downside, dragging the dollar index with it. So the dollar index looking like, or barring any heavy sell-off into the close today, it does look like it's going to notch its ninth straight week of gains. But we'll start at the beginning of the week. No high impact data on Monday. Not much for us to go off on Monday. Some consumer confidence figures out of Australia on Tuesday morning didn't really spark much in the way of market movement. But then into the unemployment rate, labour market figures from the UK in line with consensus but above previous. So an uptick in the unemployment rate in the UK on Tuesday morning. That then follows into Wednesday morning with the GDP figures from the month of July, which missed consensus. Minus 0.2% was the estimate. Actual figure came in at minus 0.5%. So unemployment rising, GDP falling. Not a situation where the bank are likely to continue hiking interest rates aggressively. Now, at one point they were calling for 7% interest rates in the UK. Now 5.25 now. Markets pricing in a terminal rate of 5.5%. Or the majority of market participants believe, obviously, in terms of pricing, it's going to be 5.5%. Obviously not a foregone conclusion, but you'd have to imagine that is probably correct. Into CPI then on Wednesday. On out of the US, obviously we had the two metrics, headline figure and also the core CPI print. Now the headline figure year over year beat consensus or estimates was for it to be up 0.4% from the month before. Actual 3.7, and slightly above. The core CPI print beat consensus 0.2, actual 0.3 in terms of the month over month figure. The yearly core CPI print in line with consensus, down 0.4% from the previous month, and the headline monthly figure in line with consensus, up 0.6% over the month of August. Now inflation rising once you include food and fuel costs. Obviously likely, well not likely, I don't know why I said the word likely, but the run up in oil, uptrend in oil, as that continues, that is likely to continue to put upwards pressure on inflation, and the upwards print in inflation is due to rising oil costs. So central bank, there's a lot of things they can do, but if Russia and Saudi Arabia continue to cut production and the supply of oil is continued to be put under constraints, there's not really a lot the central bank can do to get that down. So they won't be enjoying that development, and oil just continues to truck higher. Oil's above 90 now, dips being bought again in recent trade, and if that gets up towards 100, past 100, that will continue to be a problem and continue to put upwards pressure on inflation, which is not a situation any of the central banks will want to be in. You would have to, you would have to imagine, but it is definitely not a situation that they would like to be in. Into the ECB yesterday, and the ECB, in my point of view, are finished. They are done with their interest rate hikes. Christine Lagarde did reiterate a statement within the statement, or a comment within the statement, that says that interest rates in Europe are at a sufficiently restrictive level in order to cool down inflation, and if they are held at that level for a sufficient period of time, it will make substantial progress towards returning inflation back to the 2% target. Now that is not word for word, but pretty much exactly what she said, and she reiterated that statement within a press conference a good 4 or 5 times. We were watching it on the trade floor, yesterday, and she was very, very clear in that statement that interest rates at the moment are at a sufficiently restrictive level in order to cool inflation down if they remain there for some time. So you'd have to imagine, I don't know, I keep saying that, but they are at a sufficiently restrictive level in order to get inflation back to their target, and barring any crazy spike up in inflation, or barring any trend upwards inflation again, ECB are finished, basically, is what they have told us. Come into US data yesterday in the middle of the ECB and the decision and the press conference at 1:30 yesterday. PPI beat consensus, retail sales beat consensus. So strong economic data over the course of this week from the US. Michigan consumer sentiment a little bit later on this afternoon as well has helped the US dollar continue to push higher. Not against all the currencies though. You can see Aussie taking slightly higher, Kiwi taking slightly higher off the back of equities being higher over the course of this week. So equities moving higher have dragged the Aussie and the Kiwi with it. Dollar Swiss, dollar yen continue to trade higher. Dollar yen's back at the highs, looking like it wants to attempt and move higher again, seemingly wants to test the Bank of Japan's resolve. Dollar CAD selling off quite aggressively in line with the oil move. Euro dollar and cable have sold off pretty substantially off the back of the ECB seemingly being finished with their interest rate hikes and a raft of negative economic data or negative unemployment figures and negative GDP figures out of the UK. Continues the downtrend in cable, continues the downtrend in euro dollar. Euro dollar is obviously the biggest component in 50 or nearly 60% of the dollar index is just euro dollar. That then pushing lower basically means the dollar index is guaranteed to be higher regardless of what anything else is going on. And the dollar index looking like it is going to notch its ninth straight week of gains. But that was the close last week, so we're not too far away from it. As you can see, got 30 pips away from it. A spike higher above euro dollar, get it back above 170. May break that trend, so it's not a foregone conclusion for that just yet, but it looks like the way we are heading. You see bond yields, 10-year yield finishing higher on the week. German yields, they were lower to begin the week and then higher and then lower again. Now they're back higher, so pretty range bound week certainly in terms of bonds. But the main mover this week is oil. Oil continues its trend higher. Now if you're watching the videos earlier on in the week, we called this ascending triangle. Pretty easy trade on it in hindsight. We're looking at it ahead of time. Managed to break and has managed to continue back up to 91. Dips at the moment looking like they are being bought. A rejection of 90.50, and that looks like it wants to continue its move higher off the back of supply constraints. Production cuts continued into year end by Russia and Saudi Arabia continue to prop up the price of oil in the midst of decreased demand. These highs up at 93.60, anything up towards 100, that's not a situation central banks are going to want to be in, and that should cause inflation to rise with it. But next port of call, that kind of 93.80, 94 level, these highs back here, probably the upside target for now. Do you want to go chasing that move higher? Probably not. You probably want some sort of a pullback. That's enough of a pullback for you off 90.50. Off you go into the close for today. But pretty simple trade. Technicals aligning with the fundamentals earlier on in the week. Not a bad setup whatsoever. That's really where we're at over the course of this week. Main mover is obviously oil that continues its trend. Euro dollar, big downside. ECB done with interest rate hikes. Leads us on to the Fed next week. We'll update more on the Fed once we get around to it next week. But pretty busy week of trading across a bunch of different asset classes. Before I go, risk on sparked obviously of the ECB being done with interest rate hikes into today's session. Follow through with some positive economic data out of China. You can see industrial production, retail sales both beating consensus quite aggressively. So in today's session, the upside that has been sparked off the back of the ECB has had some follow through overnight. Some positive Chinese data, stocks higher across the board. Does that continue into US trade today? Certainly I am not going to go chasing these moves higher at the highs. If you're doing anything today, you're going to have to look at being short, buying these or continuing to buy these at the highs. It's not worked so well for me in the past whenever I've tried that, so I've learnt my lesson from that. You buy on dips, sell on rips. Unfortunately, we do not have one of them just yet. But Fed next week. What do they do? We'll break that down next week. But that's it from me then. Have a good weekend. I think we're due the last probably bit of good weather, certainly in London tomorrow. So do get out and enjoy it. Get a bit of rest and relaxation and recharge the batteries. And we'll be back next week for another week of trading. Thank you.